Welcome everybody. Today with us we have the renowned Professor Aswath Damodaran. Hopefully I pronounced your name correctly. I think everybody knows who Professor is. And then I'll just, without any further introduction, I'll just give the word to Professor Damodaran.
Okay, can everybody hear me? Is it good? How's the sound?
I can hear you fine.
Okay, so I'm going to assume that everybody can hear me, and if they cannot, you will let me know. So as I was thinking about what I could talk about, basically the way I've structured this is I'd like to talk for about 35 or 40 minutes, and then at the end of it, I'd like to actually open it up for about 15 minutes of questions. That way you can ask me any questions you want about anything. So what I did actually was put together a presentation that I've done before, which actually takes everything I've learned in valuation and kind of summarizes into 6 lessons, 6 very broad lessons that I think might illuminate why we sometimes get stuck in valuation. So let's talk a little bit about the process of valuation. One of the problems I have with the way we do valuation is it becomes so numbers driven and so spreadsheet driven that I don't think we do much valuation. We do a lot of modeling, and we call it valuation. So what I thought I'd do in this session is talk a little bit about the connection between stories and numbers, how every good valuation has a set of numbers to back it up, and how those numbers have to be connected to a story. So here's what I start every one of my classes with. I start off with a question. Are you a natural storyteller? Are you much more of a number cruncher? So I'm going to throw that question out to you. I see already about 9 people on there. So, if you're in the audience, think about this question. Are you more naturally a number cruncher or more naturally a storyteller? I'll tell you what I am. I'm a natural number cruncher. To me, stories don't come easily. I like to work with numbers. I'm more comfortable with number crunch. But there are some people who are much better storytellers. They're much more comfortable with the story. And the reason I draw that distinction is when people walk into my valuation class and I ask them this question, the class subdivides. This semester, for instance, I have 270 people in my class. About 80 of them said they were, or maybe 90, told me they were storytellers, history majors, literature majors. And about 180 were number crunchers. They were accountants, auditors, actuaries, engineers, mathematicians, scientists. And the number crunchers, of course, think that they have the advantage in this process because this evaluation is a numbers class. I'm a number cruncher. I'm going to have an easier time with this. And I let them in on a little secret, which they don't like, which is a good valuation is actually a bridge between stories and numbers. It's not just about the storytelling. It's not about the number crunching. It's a bridge between stories and numbers. A valuation that's all numbers all the time is essentially just a spreadsheet. It's a collection of numbers. A story with no numbers, just a story. It's a fairy tale. So a good valuation connects the two. And each side thinks it owns the high ground. The numbers people think that they're being unbiased when in fact they are biased. They think they're being precise because they use numbers, when in fact the numbers are very imprecise. And they think they control the data because they put a number on it. The story people think they're being creative. It's okay to be more creative rather than less creative. They think they can tell bigger and bigger stories, more soaring narratives. And I give them my end game. I say, by the end of this class, here's what I hope will happen. I hope that the storytellers develop discipline. That's what numbers brings to storytelling. And that the number crunchers develop an imagination. Imaginative number crunchers and disciplined storytellers are good at valuation. If you have just one half of your brain working, at least according to mythology, the left brain is what works with the numbers, your right brain is what does the storytelling. Use both sides of your brain. Play to your weak side, because you can play to your strong side, but that's not going to make you a better person in valuation over time. So what I thought I'd do actually is take you through the process of going from stories to numbers, step by step. So let's say your job is to do a valuation of a company. My first suggestion is before you open up an Excel spreadsheet and start inputting numbers like crazy, look at the landscape, look at your company, look at the comparators, look at the market it's in, look at the macro environment, and then take full advantage of looking at that landscape, because you cannot tell a good story about a company unless you understand the landscape in which it operates. I'm going to use a very simple example to kind of illustrate this process. A company that many of you might have heard of, it's been in the news for the last year and a half, perhaps 2 years, and it's Uber. And I became familiar with Uber in June of 2014 when I saw a news story that essentially said that Uber was being priced by venture capitalists at about $17 billion. That a venture capital round had just been raised, and that based on the venture capital round, the price that had been attached to Uber was $17 billion. To be quite honest, I was just curious. I'd never heard of the company. And when I saw the $17 billion, I wanted to value the company. The only problem was I had no idea what Uber did. And that's how disconnected you get. If you live in New York City, you always take the subway. You never take a cab or a car service company. I'd never heard of Uber. Okay. Let me take that back. I'd seen Uber on my credit card bills because my son had started using Uber and had used my credit card to back up his Uber driving. But that's the only exposure I had to Uber. So to value Uber, the first thing I needed to do was get a sense of what business Uber was in. What did it do? So the first thing I actually did was put the Uber app on my phone. That's simple enough. I hit the app and an Uber car showed up in my driveway like magic 5 minutes later. So I get in the car and I say, and I told the guy, can you drive me around for 45 minutes? He said, where do you want to go? He said, I really don't want to go anywhere. I just want to drive with you and talk to you. He thought I was crazy. But he decided to drive me around, and as we drove around, I asked him questions. I asked him questions about, how does this work? How do you get and connect? How do you connect up with Uber? What do they do for you? And he told me his story. His story was he had a regular job as a bank teller, and he needed to make some extra money to keep his family in more comfortable surroundings. So he decided to drive a car. He'd drive a car service company in his off time. And it turned out that with Uber, he could use his own car and Uber would supply the customers through the Uber app. So he said, I need Uber because without Uber, how will I get the customers? I said, okay, that's neat. Then I said, how do I pay you? He said, you don't pay me. Your credit card is already on the Uber file. And he said, when your 45 minutes are done and I drop you back off, Uber is going to charge you on your credit card, and then I will get 20%, I being the driver. The driver will get 20%, and Uber will keep 80%. And I remember asking him, why 80-20? What's so special about the 80-20? He said, I don't know. That's what they all seem to buy. So it seemed to be a number that somebody made up, and 80-20 became the rule of thumb. So I understood then why drivers liked Uber. It was convenient. You didn't carry cash with you. You got customers, and it allowed you to earn a second income with that car that was sitting in your driveway in the evening. Okay, so I understood the driver part of the process. Then I started thinking about, why do customers use Uber? As I said, I'd never used Uber, so it didn't work for me. So I talked to my 25-year-old niece, who always seemed to use Uber all the time, and my 22-year-old son. My 22-year-old son said, look, I use Uber because when I go out in the evening, I don't want to drive a car and park it and worry about driving it back. Uber is very convenient. This is a kid who would never take a regular taxi cab. It would be beyond him to actually stand in the street and call a cab. But he said, this is very convenient. It's an app on my phone, and that's how I do everything else in my life. So that's why I like Uber. And I talked to more people, and it turned out that Uber was very convenient, very quick, and very safe. So I said, okay, now I understand why customers like Uber. And in some cities, they also said it was much cheaper. That added to the benefit. So I was starting to understand how Uber worked, how the proceeds developed. So I started then asking questions. Like I asked the driver, do you work for Uber? He said, no, I don't work for Uber. I said, does your car belong to Uber? He said, no, the car is mine. So I said, basically, Uber doesn't own the cars. You're an independent contractor. He said, that's exactly how it works. Minimal infrastructure. Started understanding that this was a company that could scale up pretty easily because it didn't need to reinvest money. So essentially, my story was starting to take form as I understood more about Uber. So then I said, okay, I'm ready to tell a story. So the first story, as I sat down to think about the story I wanted to tell, here are some things I wanted to keep in mind. I wanted my story to be a simple one, because if you make your story too complicated, it's going to be really messy doing the valuation. And I want to be focused on making money. This is a business. So I can get distracted with all this side stuff. I don't want to do that. So I wanted to keep it simple and focused. And here was my initial story for Uber. In my initial story for Uber, here's what I saw it becoming. I saw it becoming an urban car service company. The key component of the urban part of that was I saw Uber becoming big in cities, but not in small towns or rural areas. In my initial story, I saw Uber bringing in new customers, like my 22-year-old son, into the business, expanding the car service business by about 40%. I saw Uber having local networking benefits, where if it became large enough in any city, it'd become even easier for them to become larger. But that would not help them if they went into another city where Didi Kuwadi was already the largest player. I assumed that they'd be able to maintain the revenue sharing system of 20% to the driver, 80% to Uber, due to the strong competitive advantages of being one of the biggest players in the game. And finally, I assumed that they would be able to maintain their existing low capital intensity model, where essentially they didn't buy cars, they didn't have infrastructure, no drivers were not employees. So that was my initial story for Uber. It's simple, it's focused, and that's what drove my original valuation. Now, the third step in the process, before I get carried away and actually attach numbers to the story, you've got to stop and make sure that this is a credible story, a story that it's a business story. I'm not telling a fantasy land story or a fairy tale. So there are three tests that I run when I have a story. The first question I ask, and it's a simple test, and it's a test that most stories pass, is it possible? It's a weak word, because lots of things are possible. But I want to make sure I'm not telling one of those impossible stories. And guess what? I've heard founders and business people tell me stories that I know are impossible. Like what? Like claiming that your company will grow at 8% a year in US dollar or euro terms forever. Can't happen, because your company will then become the market. Claiming that company will grow so fast will have 120% market share. Hey guys, 100% is the maximum market share. So I'm making sure it's not impossible. But there's a second test. I want to make sure it's plausible. Plausible is a little tougher than possible. So I have to have a sense of market potential and that you've tested products. And then probable is an even tougher leap, where you actually show me evidence that you can pull it off and make money. In the case of Uber, at least in June of 2014, the only probable business was the car service business. There was talk about the delivery business and moving business and rental business, even talk about how Uber would replace the second cars. But those are either very low plausibility, or I didn't feel comfortable enough bringing that into my story. So this is a critical part actually of valuation, is stopping and asking that question about your story. And I'll give you an example different from Uber to illustrate how this will play out. A few weeks ago, I valued Ferrari on my blog for their IPO. And in my initial narrative of Ferrari, I made them a very exclusive car company that essentially would continue to sell relatively few cars. Remember, Ferrari sold only 7,255 cars last year. But because they sell so few cars, three things happen. One is they don't have to spend any money on advertising or marketing, because the cars kind of sell themselves. The second is they can charge huge prices and make immense margins. 18% margins, what Ferrari made last year. It's about 4.5 times higher than the typical margins of the auto business. And third, because they sell so few cars, they're in a sense insulated from economic risk, because the type of people who buy Ferraris are so rich, they don't take care of the recession, recovery, it doesn't really matter to them. And all those things played out in my valuation. So that was, I thought, a plausible, perhaps a probable story, that Ferrari would continue to do what they've done for the last 60 years. There is an alternate story, and in that alternate story, Ferrari becomes more like Maserati. Remember, the Maserati introduced the Ghibli, which is the low cost, low price, low relative to Maserati. It's about, it's a sub $100,000 car. And here, Ferrari would increase their growth, but in the process, they'd also have to increase their marketing, reduce margins. That's a plausible story too. Here's an impossible story. If you told me that Ferrari would sell 500,000 cars a year, that's up from 7,255. Charge $1.5 million per car and do no marketing. That's an impossible story. So sometimes looking at the story will let you decide which stories you should even spend your time on. So this is a key part of the process, is making sure your story is plausible, probable, possible, plausible, probable. In fact, in my initial story, my probable business for Uber was an urban car service business, where the total market is 100 billion. The plausible is that would expand that urban car service business, maybe the rental market, which allows the car service, the urban car service market to grow about 6% a year. And there's a possibility that they could eventually become the second car for most people. I'll talk a little bit later about Bill Gurley and what he offered as a counter narrative, but this is it's a third step in the process, the probable, plausible, plausible test. Now comes the fourth step. You got to connect your story to what drives value. And let me take you through the Uber valuation so you can see where each part of the story is going to play out. Because I described Uber as an urban car service company, my total market was the urban car service market, which I estimated to be 100 billion in 2013. And because it's drawing in new customers, I'm going to assume it's going to be able to grow the market at 6% a year. The existing car service market is growing only in new customers. I'm assuming a 6% growth a year. So that's where that part of the story went. Because I'm assuming local networking benefits rather than global networking benefits, the market share that I gave Uber was about 10%. Not this year, next year, but at the end of the 10th year. Because I assume they have strong competitive advantages, I'm going to assume they're going to be able to keep the 80-20 split and keep their expenses low. The margin that I gave them was 40%. Because I assumed that they'd be able to continue with their existing business model, I was able to assume that they would be able to get $5 of revenues for every dollar of capital, a high sales to capital ratio. And finally, because they're a risky company, excuse me, I'm going to give them a cost to capital of 12%, which puts them at the 90th to the 95th percentile of US companies in terms of risk. And I'm going to allow for a 10% chance they will not make it. They're a young company with losses and potentially could run out of cash. That's where my story connects the numbers. Once I put the numbers on the story, the rest becomes almost academic. So by the time you look at my valuation, you're actually seeing the end result of my story. My total market is what I'm shooting towards. The market share determines my revenues in year 10. My target margin tells me how much operating profit I get. My reinvestment assumptions give me my reinvestment, and I get my cash flows, which I discount back to today and adjust for the 10% probability that I will not make it. The value that I got for Uber on June 8th of 2014 was about $6 billion. Remember, the story that triggered this valuation was throwing a number out of 17 billion. I'm coming up with 6 billion. I put this on my blog a few days later. It was put up on the site called 538, which is a site that focuses on using statistics and data. And it got wide circulation in Silicon Valley. Lots of people on the West Coast did not like this. I mean, they felt that that this was not the way to value young startups. That there was no way you could do a discounted cash flow valuation of a young startup. That's what I kept hearing. You can't really value these companies using a discounted cash flow model, and that's why you're getting too low a value. That's their argument. They said you're getting too low a value, and the problem is with the model. And I said, no, the problem is not with the model, it's with me. Because if you don't like the value, it's not because the model gave a low value, it's because the story I'm telling is a story you don't like. Now, normally this would have had a half-life of about 2 or 3 weeks. People would have forgotten and moved on. But about 2 weeks after I put this valuation up, I was sitting in Munich airport waiting for a flight, and I get an email from a guy called Bill Gurley. Okay? And Bill Gurley actually was one of the VCs who invested in Uber very early in the process. He was one of the lead investors. And the email from him said, I've just put up something on my blog. He's talking about his blog about Uber as a company and about your valuation of Uber. And it's not very kind. And I wanted to let you know before you heard about it from somebody else. So I said, thank you for letting me know. And right after I read the email, guess where I went? I went to his blog to check out what he'd written about me. And the title of his blog post was Damodaran Misses by a Mile. And I get it, right? Damodaran misses by a mile, Uber, car service company. And then piece by piece, he took issue with every single part of my story. He said, look, Uber is not a car service company. It's a transportation company. It's a logistics company. Words make a difference. It's a very different business. And logistics is any time you have to move from point A to point B, a thing, a person, whatever. You have a logistics business, much bigger business. He said it's not just going to be urban, it's going to be everywhere. It's going to be rural, it's going to be suburban, it's going to be everywhere. And he said we don't just have local networking benefits, we have global networking benefits. And he argued about connecting Uber onto the credit card companies. And because you didn't want your credit card in some strange company's accounts, you would use Uber if you flew into Jakarta, or you flew into Moscow, you flew into Sao Paulo. Now, the first reaction when I read this, he thought I was going to be upset. I thought it was great that he was giving me a different story. So I emailed him back and said, do you want me to value your story? He said, what are you talking about? He said, you've told me a story. I can put a value in your story. I can build a DCF model. He said, sure. So the next thing I did was I decided to value his story. And here's how his story altered the valuation. Because he described Uber as a logistics company, I gave him a total market of 300 billion, a much bigger market. Because he told me that Uber was a global networking company, I gave him a market share of 40%. Because he said Uber was going to maintain its competitive edge, I let him keep the 80-20 slice, and the value that I got for Uber was 53 billion. I said, that's your value for Uber. He said, I like it. And I said, of course you like it, it's your story. And the point I'm trying to make is when people complain that a DCF model gives too low a value, a model is just a tool. The model just reflects the story you've fed in. So if you don't like the value, don't take issue with the model, it's just a tool. Take issue with the story that fell into the model. In fact, in this case, I sent him back the valuation. I posted on my blog, and he said, he emailed me back and said, you know what, this 80-20 slice might not be long for the world. The competition is probably going to make it 90-10. I said, not a problem. I revalued Uber with a 90-10 slice, and I gave them a $29 billion value. The point I'm trying to make is that your value for Uber is very much a function of your story. In fact, in December of 2014, I actually posted this in my blog where I let readers pick their story for Uber. So what are you talking about? Essentially, at each stage in the process, I stopped and asked readers of the blog post to pick what they thought Uber was. What kind of company is it? Is it a car service company, an urban car service company, a logistics company, a transportation company, or an on-demand company? Second, is it local networking benefits, no networking benefits, global networking benefits? Is it, in terms of growth effect of the market, is it going to draw in lots of new customers, not that many customers, no new customers? In terms of competitive advantage, it's strong and sustainable because it's first out there, just weak because just another app. And then I valued Uber based on the choices people made. So if you look at the bottom of the blog post, I said, based on your story, your choices, this is your value for Uber. Look at the last column on this page. You can see effectively how much your story affects evaluation. I get values ranging from 800 million in the low end to 90.5 billion at the high end, depending on the story you tell. And especially with young companies, that's a key thing to remember is your story drives the valuation. And when you have big differences in numbers, it's not because there's a spreadsheet difference, it's because you have a story difference. I'm not suggesting that all of these stories are equally plausible. I think the 800 million and 90 billion are implausible stories. Not impossible, but implausible stories. So as an investor, you have to check your story and also test it to see, is this a story I'm willing to invest based on? Now, for those of you who have not tracked Uber, you probably heard that there was a second round where the value went up to 40, then 50, then the most recent round, you have a number of, I think, as high as 70 billion being thrown around. Now, and when people say, how do you explain it? I don't have to. I'm not investing in 70 billion. But would I say that somebody who's investing in 70 billion is irrational? Not necessarily. Maybe they have a story here that they believe in strongly where the 70 billion is justified. It's not my job to go around telling people that they're being irrational or unreasonable in their investing. It's their money. They can invest wherever they want. But I think you need to think through the story when you think about what value attached to a company. Which brings me to the sixth step, which is you come up with this really great story, you test it out for plausibility, you put numbers on it, you value the company, you feel pretty comfortable with the value, right? Don't get too comfortable though. Why? Because life has this habit of delivering new surprises. The surprises can come from the company in the form of earnings announcements, management change, from the sector, it can come from competitors, it can come from the macro economy. But you have to adapt your story as new stories come in. In fact, when I think about narrative changes, I classify the narrative alterations into three groups. The first and the most dangerous is when a narrative ends. I'll give you an example of a narrative end. It's a company called Aereo, which was a startup in the US, which was valued about $2 billion in March of 2014. Now, what Aereo allowed people to do is watch cable TV channels on their iPhones and iPads without paying cable fees. Too good to be true, right? But Aereo claimed to have found a legal loophole that they could exploit that allowed people to do this without having to pay the fees. The cable companies, of course, did not like it. They sued. It went all the way up to the Supreme Court, the US Supreme Court, and last summer of 2014, I think it was July 3rd, or somewhere around the June something, the US Supreme Court passed down the ruling that what Aereo was doing was illegal. Basically, overnight, that $2 billion value went to zero. That's a narrative break. Here's another example. Let's say you were an investor in Ashley Madison. I remember them. Let's say you did this 8 months ago and the company's valued around $1 billion. You felt good, right? Lots of cheaters in the world, big market, you're going to make lots of cash flows, high growth, high value. Only problem is a few months later, there's this privacy breach where all the names of everybody who's an Ashley Madison customer is made public. Now, if you're a cheater, this is the one thing you don't want to happen. And if you think about Ashley Madison as a business, do you think anybody's going to trust them from this point on? That's it. The business model is done. That's a narrative break. Thank God that doesn't happen that often. More frequent are narrative shifts and narrative changes. Narrative shifts is when you get some information that leads you to believe that the initial business model you assumed is okay, but that model might have improved or dropped off depending on the news story. I'll give you a couple of examples relating to Uber. This summer of 2015, early in the summer, the California Labor Board decreed that Uber drivers were not independent contractors, but employees. Saying, so what? The minute a driver gets classified as an employee, Uber has to pay Social Security taxes and other taxes. So that's the first cost that you hadn't built into the original model. They also are more liable if the Uber driver gets in an accident, because the person suing is now suing the driver and his employer, which now turns out to be Uber. So when that story came in, I had to go in and adjust the operating margins for Uber to reflect the fact that they now had more costs. In the US, there's talk about insurance laws changing. So if you drive an Uber car or a Lyft car or any ride-sharing company car, you will have to pay extra insurance. If that's the case and Uber bears some of that cost, that's going to affect the valuation. So those are narrative shifts. The story you're telling remains the same, but you're having to alter that story based on new stories coming in. The narrative change is when the company does something you did not expect them to do. For instance, with Uber, I get an email from Uber saying they've started this new service called Uber Delivery in Uber Move Uber Delivery in LA, where they deliver goods and services and restaurant meals, a delivery service. And then they're Uber Move in New York. These are new businesses they're pushing into, and if they succeed in these businesses, and I get a new story that they're succeeding, the Uber Move in New York is doing much better than expected. That's a change in my story. It's a new business I hadn't factored in. And to give you a sense of how even small stories can affect value, towards the end of last summer, I don't know, but probably August or September of last summer, my son, who was 15 then, had a friend over who was also 15. The time for the friend to be picked up comes about 6 o'clock. The car pulls in the driveway. Usually, I live in the middle of suburbia. In the middle of suburbia, the car that usually pulls up to take a son home is usually the mom car. Mom's in the car, she pulls up, the son gets in the back seat or the front seat, and they go off. Car pulls in, it's a sedan. I've never seen this car before, and there's a guy with a beard sitting in the front row. So I turn to this kid and say, does your mom have a beard? He says, no. He says, is that your mom's car? He says, no. So whose car is that? He says, it's an Uber. My first reaction was, I've got to go back to my spreadsheet to revalue Uber. Do you see why? Because in my June 2014 story, what was the story I was telling about Uber? That was an urban car service company. Here I am in the middle of suburbia, and a mother has trusted Uber to bring her son home. That changes my narrative, right? So I've got to go back and redo the narrative. So in fact, in September of 2015, what I did was I collected all the news stories that have come out about Uber, and there are hundreds. And I looked at how those news stories would play out in my narrative. The good news is that ride sharing is moving faster into more markets than I ever thought it would. The bad news is the competition is getting much more intense. So I bought in both the good news and the bad news, and I redid my valuation, and the value that I got for Uber was still about 20-something billion, 24 billion, well below the 70 billion. You're saying, so how do you explain the 70 billion? Remember what I said. It's not my job to explain the 70 billion. All I'm saying is, as an investor, it doesn't make sense for me to invest in Uber. So that's the 6-step process. In Uber in September 2014, this is what my updated valuation looked like. Right? So you can see this. My $100 billion market has now become a $230 billion market. I'm going to assume a much bigger increase in market size because the news stories suggest the market's growing faster. I am assuming some weak global networking benefits because there does seem to be this stickiness where people, once they get used to an app, are unwilling to. I am assuming that the 20% slice is going to drop to 15. It's already done that effectively because these car service companies are offering discounts to customers. Margins are going to get smaller because competition has become much more intense. The cost of capital has decreased because Uber has survived, is now actually closer to the 75th percentile. I'm going to assume that they've collected enough cash that failure is no longer an option. That's my $23 billion value. So I posted this, and of course I get emails from people who are old-time value investors saying, how can your intrinsic value change so much? And I said, with a company like this one, it's exactly what you should expect to see. So if you're stuck on this notion that intrinsic value is somehow this fixed, sticky number that never changes over time, let it go. With companies like this, as your story changes, so will your valuation. So that's really what the connection between stories and numbers I wanted to bring home, and what I'd like you to do to master this process. And valuation is a craft. You learn it by doing it. Is pick your company, right? Think about the story you tell about the company, convert it to numbers, and do it again. If you're a number cruncher, when you first do it, you're going to face the same problem I did. It's like pulling teeth. You don't want to tell the story. You want to get to the spreadsheet. You want to start entering numbers. Fight the urge. Force yourself to tell stories before you put numbers. So when you show me a spreadsheet and I point to a spreadsheet and say, why are you using that number? I don't want you to give me an equation or some page from a textbook. I want you to tell me the story behind every number. In a good valuation, in fact, I know this word is going to sound weird, a valuation with a soul, every number will have a story behind it. And every story will be connected to a number. That's the challenge in valuation, is you should be able to bring all that creative stuff into your numbers. It makes valuation a lot more fun, to be quite honest. And in fact, I think this is what you need to do if you want to survive in this business. And the reason I say that is if all you're doing is plugging into spreadsheets and chugging, I really don't need you. After a while, I'm going to create an app. A computer can do this much better than you can without the bias you bring to the process. So if you want to bring something to the table, this has to be what you bring, that connection between stories and numbers. So pick your company. I was in, if you see my valuation of Lukoil from November of 2015, you can see the story I'm telling about Lukoil. That it's a company that, in spite of the drop in oil prices, because it's lightly levered and has access to reserves, will survive and make it back. That's what's driving my valuation of Lukoil as an oil company for the long term. Okay? So depending on the company, your story is going to, so pick your favorite company. Technology, it doesn't matter, commodity. In fact, my suggestion is pick companies in different businesses, tell a story, create the inputs, value the company, listen to others, tell others the story, make them give you feedback and see if you can bring the feedback into the numbers. It's a process, and you will find that you get better and better at the process as you work on it. So work on your weak side. Right? So if you're strong with numbers, work on your storytelling. If you're strong with stories, work on your number crunching. Valuation is truly a bridge between the numbers and the stories. That's about all I wanted to say. So if there are any questions, I'm open for whatever questions you might have on this or anything else you want to add on.
So yeah, thanks a lot for the lecture. I had a couple of questions that my friend wanted to ask you, but he was unable to attend the webinar. So
Okay.
the first one, okay. So the first one is he wants to know what MBA or master's program he needs to take at New York Stern to make sure that he'll take your course. Like he will be able to.
You got to do the full. If you're in the full-time MBA, then you almost guarantee to take one or both of my courses.
So which courses do you teach right now?
I teach corporate finance the first years and valuation in the second years. They're both electives, but I teach them in a really big room, so everybody wants to take it will be able to take it. So corporate finance in the first year and valuation in the second.
Okay, and the second question was he wants to know whether you'll continue teaching in the next 4 or 5 years, or you'll move into some other industry, or you'll do something else.
I'll be teaching. The question is whether I mean, God willing, right? I mean, you can never say 4 or 5 years ahead what you'll be doing. But assuming that I'm alive and healthy, I will be teaching. I will probably be teaching at NYU. The reason I say probably is at the end of the next year, I have two-year sabbatical coming. So I'll be gone for perhaps at least 1 year, maybe 2. And my family is moving west. So basically we're going to move towards California. but I will still fly out to NYU and teach my classes at least in one semester. So I will still continue to teach. And so that's my plan right now, is to continue to do it, but ask him to watch out for the sabbatical. I will not basically ruin 2 years by going sabbatical back-to-back years, but I do have 2 years of sabbaticals coming up.
Okay. I'm wondering whether the guys want to ask any questions. I just told them that they can either type them in the chat or say it out loud.
I don't see any questions coming on the chat yet. So.
Hi.
I can hear you. Can you hear the guy? He's trying to.
He says,
can you hear me?
Yeah, I can hear you.
Yeah, thank you. Thank you for the presentation. I have a question about making a story. You were taking the example of Uber, and Uber is quite an easy company to make a story because you can use the service, you can make it your own experience, and then
I think Uber is a really tough company to make a story because you don't even know what business it's in. I would argue that Ferrari is an easy company to tell a story. Uber is not an easy company to tell the story. I mean, the reason it sounds easy to you is you heard my story, right? But you don't even know what business it's in. If it's the on-demand business, how do you even start telling a story unless you know what business it's in? So I actually think Uber is. So give me your example of a company where it's tough to tell a story.
Where it's tough to get a story.
What would be a contrasting? What?
The company where it's tough to get a story.
Yeah, give me the name of a company where so give me a contrast. If you think Uber is easy, I'd like to know what your tough company is.
Well, I think it would take like a largest B2B company like oil companies. The companies that are
very simple. There's no story to tell. What's the story you're going to tell about an oil company that's complicated? An oil company takes oil out of the ground, sells at the prevailing oil price. So the only twist in an oil company is something about where your reserves might be. So an Aramco story might be that you have access to low-cost reserves as opposed to a Venezuelan oil company. So oil companies are slam dunks. There's no storytelling really worthy of the name. It's all about, so I think oil companies are no-brainers. What story are you going to tell about Gazprom, right? There's really not much room to run. It's not like you can get into new businesses. It's all about getting reserves out at the right price. So your story is really about oil prices.
Okay, well, if we take some industries which are connected to like very new developments like computers and stuff, where it's like you need to have an expertise to get the story.
Computers are not a new development. Computers are 40 years old. They're already ancient. So that's why I'm saying give me the name of a company. So because without the name of a company, we can't talk about abstraction. So when you say, so are you talking about a software company? You're talking about a business services company? I mean, computers are not a business. So unless you're manufacturing computers. So you got to tell me what business you're in. Are you selling software? Are you selling services? Are you selling, attachments for computers? So I would think those companies are very simple to tell a story on. You asked me to give you a story about Adobe. It's a business software company. It's tied to the growth of design, and so it's storytelling shouldn't be difficult for any of those companies. So what I'd suggest is pick what you think is a difficult company. Try to think about the story you have to say about that company.
For example, the company of the Elizabeth Holmes. The company about the tests the blood.
Very simple. Did you read my blog post? It's a very simple story. What is the story she was telling?
She was telling the story about that you can make the blood tests in a more very...
It's a very simple story. So she was telling the story about how she'd come up with a way for testing for blood that did not require a syringe, required very small amounts of blood, and you could do 30 tests on that. It was much less expensive. So it's actually a very simple story going after a very big market. Those are actually and that's part of the reason people didn't want to ask questions, because it was this very simple story going after a huge market. The blood testing market is $200 billion. So if you've really developed a technologically innovative way of testing for blood that's both cheaper and more convenient, you're going to be worth a ton of money. That's why people gave them $10 billion. The only thing they did not stop and ask was, does it work?
Yeah, exactly.
Sorry, that's I think the problem with that's the part of the story that people were not. Remember the possible, plausible, probable with a blood test. To go from possible to probable, you got to pass through an FDA approval process, right?
Mm-hmm.
So this is actually a very, very, very specific probability question, which is what is the likelihood that the blood test you've developed will actually be a blood test that can be used? And that's the part of the story that people didn't seem to want to ask questions on. So it's in step 3 that people did kind of fail their due diligence in terms of asking that question. So Theranos is actually a very simple story. It just happened to be a story where people did not stop and ask the probable, plausible question enough to make sure it was a story you could put a lot of value on.
Thank you.
Okay, so since you mentioned that you did a variation on Lukoil, right? So I just wanted to know what your thoughts were on Rosneft, the other company.
You know what? I will not touch Gazprom or Rosneft. They're corporate governance nightmares waiting to happen.
Okay.
I'm not sure. They're companies that might be worth a lot, but I have no idea what my share of that is worth because I have so little power in these companies that I would not trust my holding to those powers. So to me, Lukoil is, I mean, it's got, by Russian standards, Lukoil is about as strong a corporate governance standard as you're going to get in the oil space. But Rosneft and Gazprom, I mean, I wouldn't even touch them with a 10-foot. I don't care how cheap they look, because they can get even cheaper given how weak the corporate governance is in both companies.
Okay, so we have, if you guys have more questions, it's time to shoot them. Either say it out loud or type it in. So just give them about like 30 seconds maybe. If nothing else pops out, then we'll just conclude the session. Okay, so a guy is asking in the chat, what is the step between possible to plausible in social media companies?
Okay, so I actually see it now. For the possible to the plausible, social media companies, what they offer is users, right? But users are not a business. You got to be able to make money off the users. So to go from possible to plausible, here's what I would ask a social media company. How do you plan to convert those users into revenues? And there are 3 models. You can have a subscription-based model where users, like LinkedIn does, right? You have to pay for the LinkedIn premium, the extra. You can have an advertising-based model, or you might have a model based on retailing where you sell the stuff to your users. So to go from possible to plausible, you got to show me how you're going to be able to make that. And I'll give you an example. You ever heard of Snapchat? Snapchat is this company where if you take pictures, the pictures kind of disappear in like 15 seconds right after you take them. So teenagers love it. And it's a company with lots of very loyal users. My daughter is a very big user of Snapchat. So there's like 30 million very loyal, intense users, people who use it all the time. The only problem is it hasn't figured out a way to run advertising that sticks, because the advertising also disappears in 15 seconds. So if I were an investor in Snapchat, the question I would have for them is show me what you're doing to be able to advertise to users. Because if they cannot show me that, they haven't gone from the possible to the plausible. If they can show me that they're working towards a solution, then they've gone to plausible. But for the plausible to become probable, I actually need to see ads on Snapchat. I actually need to know that people are willing to advertise. That takes it from plausible to probable. So possible to plausible just requires that you show me a pathway of converting users to revenues. Plausible to probable requires something more tangible, actually showing revenues. The new normal in the world economy is there's no new normal. Right? I mean, it's basically we live in a world of change. And so that's why I think when people say, well, when will the crisis end? I said, it's a never-ending crisis, because it'll be one crisis on, this is going to be a rolling crisis, because that's the nature of a global economy. Everybody's problem becomes everybody else's problem. You think you're all stable, and the next thing you know, Sao Paulo, Brazil blows up, and it affects you as a country. Argentina has an election, and it affects how Thai markets work. So we're all connected to every. So to me, the new normal is that things will change. Your equity risk premiums will have to shift on a day-to-day basis. And I think the slowdown in China is exactly what you'd expect, right? Because it's the law of large numbers. When you're the 7th largest economy in the world, as China was 10 years ago, growing 10% a year is not a problem. When you're the 2nd largest economy in the world, which is what China is now, you can't grow 10%. There is no way, none, absolutely, there's zero chance that China will grow 10% a year for the next 10 years. It's impossible. It's not even implausible, it's impossible. So I'll make a safe prediction that if you look at the real growth in China over the next 10 years, it's going to be closer to 5% than 10%, and they'd be lucky to hit 5%. Because it's just the nature of the process. So any story, and this is where it connects to stories, that were built on the premise that China would keep growing at 10% a year for the next 25 years. And I've seen people sell Chinese companies based on the story. Those stories are now broken. So if you invested in a company because you thought China would grow 10% a year for the next 25 years, revisit that story, because that story is no longer going to work.
Okay, so I see another one here.
Any non-traditional sources. I use every possible source, traditional, non-traditional. For Uber, my source of information was my son. I don't ask my son that much advice about other products, but this was one where he knows more than I do. And especially with social media technology space, I need to talk to people who are much more in that space than I am. My 15-year-old, 16-year-old now. I ask them about how, are your friends using Facebook? Have they moved on to something else? So I'll use information from wherever I can get it. I have no traditional or non-traditional. It's just information that I need to be able to value a company. And trying a product actually doesn't help, because that just tells me whether I like the product. So the fact is, I can walk into a Tesla showroom and drive a Tesla, but it has zero influence, or should have zero influence, on my valuation of Tesla. Because anecdotal and personal information is often not that useful in valuing a company. Well, the last thing on biotech and growth, I think the biotech industry is really a young pharma. To me, biotech is just earlier life cycle pharmaceutical companies. The key to narratives in the biotech business is that the narratives have to make it through barriers, which if they don't make it through, the narrative ends, right? So if you have a blockbuster drug working its way through the FDA approval process, if it doesn't get approved, the game is over. So Theranos, actually, that's your biggest concern, right? You valued the company at 9 billion just a few months ago. If it turns out that the blood test is not going to make it through it's not a question of them not supplying information, just is not going to make it through the approval process, that 9 billion could go to zero. So with biotech companies, that's always a concern, is its probabilistic risk, which is discrete risk that you will not make it. Very difficult to show in your cost to capital, but risk that you have to build into your valuation nevertheless.
Oh, okay, so it looks like there's nobody else in the queue. So okay, so I think we should stop here. So Professor, thanks a lot for your time.
You're welcome.
Everybody who, when I started marketing the event, everybody was really excited about this, because no matter where you live in the world, if you are into finance, you know who Professor Damodaran is. So thanks.
You're welcome. If you have it recorded and you want to use it, feel free to use it. I don't know. Did you record it or no?
Yeah, it's recording now.
Basically what it is. So whatever you want to use it for, that's fine. So
yeah, okay. So thanks a lot. Yeah, so we've raised some money for the local charity thanks to this event, and thanks again for your time, and hopefully sometime in the future, if you know, if you have time, we'll run another one.
Absolutely.
On this. Okay.
Take care. Bye bye.
Bye. Have a good time.